They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a billion-dollar mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. If you work in the mortgage industry, your career is your engine. It's what pays your bills. It feeds your family. It gives you the freedom this business promises. But here's the truth. Nobody says this out loud. Getting into the industry is confusing. Switching companies can be dangerous. And hiring talent? Most leaders are terrible at it. So today, I'm breaking down all of it. In part one, I'm going to discuss how to launch your mortgage career the right way, step by step. Part two, how to switch companies without blowing up your book of business. In part three, how branch managers, area managers, and recruiters can actually attract and retain top talent without wasting time, wasting money, or ruining their reputation. And yes, I'm also going to introduce our brand new, first of its kind service. We call it TLOPS Career Advisory. It's a free resource for mortgage professionals who want guidance, clarity, direction, and honest career advice from people who have actually built massive sales organizations. I'm Dustin Owen, and this is the DO Show. Part one, how to launch your mortgage career the right way. You see, I didn't start in mortgages. I actually got started in television advertising. I was a rookie of the year selling TV ads. So I knew sales. I knew how to prospect. For the most part, I knew how to handle rejection. But I didn't know a damn thing about, debt to income ratios, Fannie Mae guidelines, how to read a credit report. I found the mortgage industry the way a lot of people still do. I found it through a relationship I already had. I found it through an ex-colleague. Yeah, it was an ex-colleague that introduced me to a top producer. That top producer introduced me to a recruiter. That recruiter then hooked me up with an interview. And that interview led to a company with a 9-week training program that was highly selective. By highly selective, I had to do a one-on-one interview. Then I came back for a group interview. Then I had to go back for yet again another one-on-one interview. They hired 1 out of every 10 applicants. So I was fortunate. I was one of the 10 that actually got hired. I was also lucky because I never had to take the 20-hour pre-licensing course. But here's what you need to know about the 20-hour pre-licensing course and the SAFE exam. These courses do not teach you how to be successful. They do not teach you how to build a business. They teach you how not to go to jail. They're a barrier of entry, not a blueprint for success. Everything that actually makes you successful comes after licensing. So when you are taking your 20-hour course and studying for the exam, you must treat this as if it's already your career. You need to be all in with your approach, your focus, and your dedication. The people with the highest probability of success are those who treat this as if it is already their only way to provide for their family. And if you fail the SAFE exam the first time through, don't get discouraged. Almost half the people who take it do not pass on their first attempt. I know dozens of successful originators who make above average to even great income, and they did not pass their first time through. You also need to understand this. It takes 2 years to build your mortgage career. That's 2 years of learning the craft, 2 years of developing relationships, 2 years of building your brand, 2 years of getting consistent, 2 years of building momentum. The environment you choose will make or break you. You want to be surrounded by people who already have the career you are trying to build. Let's walk through the 6 real-world steps to launching your mortgage career the right way. Step 1, take the 20-hour NMLS course. If you want to originate mortgages, your starting point is the 20-hour NMLS pre-licensing course. NMLS stands for Nationwide Multi-State Licensing System. There are many providers, but we have a great relationship with Knowledge Coop. They do a great job delivering the content and preparing you for the next step. Just remember, the course is the beginning, not the end. Step 2, well, you need to study for the exam. Once you finish the course, you need to pass the SAFE exam. SAFE stands for Secure and Fair Enforcement. This is the national licensing test. Almost half the people who take this exam fail it in the first time. Not because they're dumb, not because they can't be great originators. They fail because they don't respect the test. You need a study system. For this, we recommend MLO Study Buddy. They provide flashcards, notes, practice tests, and study support. You can find them on Facebook as well as online. And when you do, say what's up to our boy Rocky Lagurgio. Treat this step like your future depends on it. Well, because it does. Step 3, well, take and pass the exam. Step 3 is straightforward. Take the exam and pass it. If you fail the test the first time, it's not the end of the world. You regroup, you study, you try again. Once you pass, you are licensable. Now we can move into the real arena, choosing the right employer. Step 4, well, how to find the right employer or even the right channel. This is where most rookies misunderstand the assignment. They say, I'm looking for a sponsor. No, you're not looking for a sponsor. You're looking for a career opportunity. You're looking for an employer. You're looking for leadership. You're looking for an environment and a platform that gives you a real shot to success. To do that, you must understand the 5 main ways you can enter the business. You can be a mortgage broker, a mortgage banker. You can work for a bank, work for a credit union, or even work for a call center. Mortgage brokers usually offer the greatest flexibility, a wide variety of lenders and products, and the ability to earn the most revenue per loan. But brokers often come with less structure, less done-for-you guidance, and require more self-reliance. This can be an amazing experience for those that are self-directed. It can be tough for a rookie without strong leadership. A mortgage banker is often a hybrid between a broker and a bank. You usually get more flexibility than a traditional bank, but with more structure and support than a small broker shop. Now, when it comes to banks, banks come with structure, they come with support and systems and products, and sometimes even internal leads. But you are usually operating inside of corporate America. You may have stricter rules on marketing and branding. You often represent the bank's brand more than your own brand. Credit unions, they're often very competitive with pricing. They have loyal members and they can be fantastic platforms. But they sometimes have older technology. They have less aggressive compensation structures. And lastly, that leads us to call centers. Call centers guarantee you leads. You will get daily reps talking to homeowners and home buyers. You will become skilled on the phone. But no part of that business is yours. If you leave, you do not leave with a book of referral sources or a client base that truly belongs to you. You can make great money at a call center, sure, but if you walk away, you're starting all over. Regardless of channel, when you are new and not yet funding 3 to 4 loans a month, you require an investment from your employer. You are asking someone to invest time, money, and resources into you. So your job is to stand out and to choose wisely. You should be looking for local leadership, someone that you can see and talk to, a local presence or even a local office, a manager with a track record of developing rookies, a branch that's already closing loans consistently, systems and processes that are already built, a team that'll help keep your files on the rails. You should be looking for a culture where people are doing what you want to do. Your first opportunity is not about compensation. It's not about who pays the most basis points. It's about training, culture, resources, mentorship, stability, and a place to build your foundation. Now, step 5, let's talk about that foundation. You have to learn the basics. Once you've found employment, now comes the part that separates pros from posers. You have 2 jobs. Learn to generate business and then learn to do the work correctly. On the technical side, you must learn how to read a credit report, calculate income, calculate debt to income ratios, calculate loan to value, run and read AUS, price out a loan, lock in a rate, understand the difference between a conforming loan, an FHA loan, a VA loan. You should be able to explain an ARM. You should be able to calculate and price PMI. You should understand and be able to explain closing costs. These are blocking and tackling for mortgage loan originators. How do you learn the basics? Well, there's free resources like our YouTube channel. You're probably wondering, how do I learn the basics? Well, y'all, I have good news. There are free resources out there. One of the best free resources is our very own YouTube channel, at TLOP Entertainment. Make sure you're subscribed. Watch the content, study it. Now, there's other resources. If you're a mortgage broker, reach out to your account executives and ask what training and tools they provide. If you're at a credit union, a bank, or even you're a mortgage banker, connect with your mortgage insurance reps. Companies like MGIC, Radian, Essent, Arch, Enact, they all offer free technical training. Now, there's paid resources as well. The Mortgage Bankers Association has their School of Loan Origination, and Zenix has this product called Ground School. I have personally put over 100 people through Ground School. Whether your company pays for it or you invest yourself, this is how you go from licensed to skilled. Step 6, well, this is the final step and arguably the most important. You need coaching in order to become the kind of rookie who actually makes it. Once you have some technical competency, the focus shifts to performance, habits, and growth. This is where coaching and mindset matter. Rookies who make it become obsessed with their personal brand, their marketing, and their networking. They understand it's their job to get a lead a day. They meet with potential referral partners on the regular. They treat mortgage as a full-time career because it's not a side hustle. They work 40 to 50 hours per week. They follow a playbook. They have a great manager or a coach, and they listen. They usually have a track record of success in other areas of life. Rookies who don't make it, they don't make it because they don't prioritize marketing or prioritize networking. They don't build relationships with realtors, builders, and financial advisors. They don't study. They don't seek coaching. They don't show up consistently. They don't put on their uniform. They don't go to work. And when they're at work, they don't actually do anything. All of that is what I call the what not to do. Now, for some originators, their branch manager is their coach. For others, their employer provides coaching or sales training. But many, and I mean many, mortgage brokers, loan officers, loan originators need outside business coaching and sales training. That can be free content, like again, subscribing to our YouTube channel at TLOP Entertainment. It can mean reading books. It can mean attending conferences, or it can mean joining a coaching community like the one we have, TLOP's Originator Coaching. For more details on TLOP's Originator Coaching, go to our website, tloponline.com. That's TLOPonline.com. actionableonline.com. And for those who seek coaching, let me share their stories. Here are real people who followed our blueprint. We got Ben up in Boston. He had never closed a loan before he entered into our coaching boot camp. Within 1 year, he became Rookie of the Year. Now, he's a President's Club achieving producer for a top 10 lender. How about Amanda? She was working at a title company when I first met her. She had only funded 2 loans. I not only helped her navigate a career change, but she is now the #1 lender in her city and the #1 lender for her company in her state. And then we have Lindsay. Lindsay went from $1 million a month to $3 million a month and now runs her own brokerage. And Sarah, just recently, after 6 months of coaching, Sarah increased her income by 50%. So again, whether you seek outside coaching or internal coaching, you can see we're having a mentor, a business coach, a sales trainer, somebody who can shorten your learning curve. You can see where it brings the most value and it has its power. That's part 1. Now let's move into part 2. Part 2 is for the loan originators who already have experience. And you're asking yourself, man, do I need to change companies? So, if you're a mortgage broker, a loan officer, a branch manager, or even an area manager, and you already have experience, that means you survived at least your first couple years in this industry. You've taken some beatings. You've had some wins. You've built some relationships. But now you're asking yourself, do I need to change companies? Let's jump into it. And here's the truth. For every 7 originators I talk to who are thinking about making a move, 4 of them do not need to move companies. What they need is a new conversation. They need to advocate for what they want. They need to speak up. They need to negotiate. They need to own their role and own their situation. I have found the grass is greenest typically where you water it. Listen, I've made 5 career moves since 2004. My first move came from really 2 things. The first, I was pretty confident my company was in financial trouble. And the second is I had another company offering me an opportunity to lead and grow in a way that my current company wasn't. What's crazy is that 100 days after I left the first company, the second company went out of business, as so did the original company. I call that welcome to the early days of the financial crisis. Now after that, I landed with a company where I stayed for 17 years. And trust me when I tell you I had plenty of opportunities to leave, but I stayed. And I stayed because I wasn't in pain. I wasn't being restricted, and I couldn't be convinced that there was a better opportunity out there for me. That's the mindset I want originators to adopt before they jump. When an originator is considering a move, the first question is, why? The second question is, what will be different? Are you changing companies because something is broken? Are you changing companies because changing companies is easier than changing yourself? Those are 2 very, and I mean very different things. Let me give you 2 stories of originators I advised not to move. The first person is an originator that I talked to who wanted to leave her company because another lender was offering her a P&L model. When I asked her why she wanted to be on a P&L, her answer was great. In fact, it was probably the only answer she could have given me. She wants to have a say in how much revenue was being generated per loan, and more specifically, how that revenue was being used to compensate her, her team, and how it was being reinvested into the overall operation. Total side note, anyone looking to run their own P&L, please remember the L stands for loss. If you are ready to possibly incur losses in order to have access to profits, then a P&L might be a good option, but it is not for everyone. Now back to her situation, she liked her leadership. She didn't have issues with pricing or product. Her loans were closing and they were closing on time. So the issue wasn't her company. The issue was that she hadn't had the conversation about operating on a P&L with her current leadership. Well, after she had that conversation, you can guess what happened. She is with her current employer and she's on a P&L. And now the second originator that I talked out of leaving, this guy believed he really wanted to leave. He was convinced. But after some digging, we found out that what he really wanted was more autonomy. He wanted a louder voice. And he wanted a sense that someone was participating in his future growth. So what did we do? Well, we had him sit down with his manager, and he negotiated out of certain meetings where he felt micromanaged. We had him ask for a monthly one-on-one where he and his manager acted more like collaborators and less like boss and worker. Then we had him ask for, and by the way, he received an invitation to sit on his company's advisory board. That gave him the voice that he was missing. And then finally, we helped him negotiate $2,000 a month from his current employer to pay for our elite coaching. That gave him access to our full TLOP originator coaching community, plus 2 one-on-one coaching calls a month with a TLOP coach. He didn't need a move. He needed alignment. Now, for the 3 out of 7 who should make a move, it typically comes down to 2 things: support and opportunity. Support, to me at least, starts with a local team, local leadership, and some form of brick and mortar. Support looks like this. It looks like monthly branch meetings. It looks like events such as lunch and learns and happy hours on the monthly. It looks like celebrating success and having friendly accountability as well as competition. Support includes marketing support. It includes processing support. And these processors, they need to be phenomenal on the phone. We need processors who talk to borrowers, who collect conditions, who act as an extension of the originator. Support means someone is helping you manage your pipeline, making sure your files are underwritten in 48 hours or less, making sure your conditions are reviewed in 24 hours or less. Support includes a company that invests in your overall well-being by offering sales conferences or access to coaching. Opportunity is about growth and advancement. What are your current opportunities for growth? What are your current opportunities for growth at your current company? And what are the growth and leadership opportunities at the new company? Compare those two. When there is a better leadership and better growth opportunities at the new company, it's hard not to encourage someone to consider a move. Now let's talk about the traps. The first trap, it's the bait and switch trap. Be very careful. There are plenty of companies out there that want to show you certain pricing models in order to get you in the door, but then change it once you've onboarded. Protect yourself by talking to other originators who have onboarded in the past 24 months. Ask for access to raw pricing and get everything in writing. Always, and I mean always, get it in writing. Be wary of big sign-on bonuses that come with crazy clawbacks or non-competes. If you take a big check, expect big handcuffs. But you can negotiate for those handcuffs to be prorated. For example, let's say you took a 36-month clawback on your big fat sign-on bonus. You can actually negotiate to have every month you serve be prorated back. So for example, if you worked somewhere for 18 months and you had a 36-month clawback, if you wanted to leave after 18 months, you wouldn't owe the full 36 months worth of that sign-on bonus. You would owe 18 months, which is half. Not great, but still better than a stick in the eye. There's also the product trap. Please, whatever you do, do not change companies based on one niche loan. I once had a loan officer who wanted to leave because another lender offered FHA 203K in-house. And I remember asking her, in your 20-year career, how many of those loans have you ever funded? And her answer was, well, not many, but if I had a really good product, I'd probably do a bunch. So guess what she did? She made the move. And she stayed there for a couple years In those 2 years, she never once did a 203K. Here's another issue I have with niche products in general, especially when one originator is leaving one company for the next. And I've seen this happen one too many times in my career. What happens when that niche product gets discontinued? All of a sudden, you made a move for that product and that product is no longer available. Don't fall for that trap. And then there's this one, the litigation trap. Man, the mortgage industry is extremely litigious, especially when it comes to branches or LOs leaving. And I'm disgusted by how litigious we can be. And that disgust goes both ways. To the company that bullies the LO, as well as to the LO who tries to take what doesn't belong to them. Here's my rule of thumb. If a file has been apped, locked, disclosed, and it is in the system with your current employer, it stays. Now, that does not mean your referral sources and past clients can't call you on your cell phone number. It doesn't mean that you can't use tools like Model Match or Redder to find data on people you've previously served. But you do not take private loan data, so that means no social security numbers, no loan numbers, no bank account information. And lastly, let's talk about questions you should ask a potential new employer. Sure, we're all going to ask about products and programs and pricing and marketing and processing, right? That's the basic due diligence. However, you need to research by talking to those originators who have been there already, those that onboarded between the last 12 and the last 36 months. Stay away from originators who've only been with the company for 3 to 6 months, as they are still in the honeymoon phase. When figuring out if this new company could be the right employer, you sometimes need to ask them certain questions. Ask them questions such as, what are your growth goals as a company? And then figure out, do they align with yours? Ask them, how can I benefit when you grow? How can I participate when you grow? Who are your top originators? And where do I fit in? Listen, if you do $24 million a year, but you're going to be one of their top 3 originators, are you really surrounding yourself with the right people? The people who think big enough? Ask them about their sales culture. Have them walk you through their sales meetings. Have them walk you through their sales conferences. Have them explain how they support originators like you. Now let's jump into part 3. This is the part that if you are recruiting or attracting loan originators because you're a producing manager or maybe even a divisional executive, heck, you may even be CEO of your own company. This part's for you. This part is for hiring managers. There are only 3 reasons why an originator leaves their company. Know that. There's only 3. And reason 1, you typically don't want those people. They are running from themselves. They are running from the man or the woman that they see in the mirror. They are looking for change externally when the change they need is internal. The first thing I look at is how many companies has this person worked for in the past 3 to 5 years. If they have worked for 3 to 5 companies in 3 to 5 years, and they're a low producer, y'all, I don't want them. There's nothing about my leadership, my programs, or my products that'll create the drastic change they need. Now, the second reason why someone would leave to join your organization is because they're being forced to move. Their company is going out of business. Their company is merging. Their company is being acquired. Maybe their company is just no good at closing loans on time. It's possible their company just did a drastic comp change that is punitive to the originator. These are people we love to recruit. Why? Well, because there's pain, and we can offer shelter to these people. We can offer a better platform. We can offer comfort and stability. But if the first time you meet or speak with this person is after it has been announced publicly that their company is feeling pain, your chances of landing them are very low. This is why recruiting is such a relationship game. Just like originating is relationship-based, where LOs are building partnerships with realtors and other referral sources, recruiting is relationship-based, where you're building relationships with originators and branch managers. The best recruiters have the most relationships with the most producers in their markets. They build these relationships by being active on social media, by attending conferences and trade shows, by being present at MBA meetings or Realtor Association events, heck, even attending Builder Association events. Anywhere where you can network, be known, and stay top of mind, you want to be. And then you want to be the first phone call that these type of originators make when they've just had enough. You do not want your first phone call to them to be after it's been announced that their company is closing or being acquired. That just makes you a shark and doesn't make you a leader. Now, the third reason someone would leave their company to join yours is my favorite type. These are men and women who are happy where they are, but you offer them something their current company does not. When I left my company after 17 years to join my last employer, I was able to onboard 5 branches in just 6 months. I pulled some from the broker world, some came from banks, and some from other mortgage bankers. They didn't live in the same state. They weren't in the same time zone. The one thing they all had in common is that I gave them an opportunity their current company was not offering. These opportunities typically look like advancement, whether it's from branch manager to area manager or from top producer to producing branch manager. I was able to move them from a non-P&L model to a P&L model. I was able to offer them coaching, mentorship, and leadership. Plus, I opened my playbook for them. I had built systems and processes that were best in class. It's what every coaching company preached. It's what every top producer followed. I found a way to build it at the branch level, support it with 2 sales admins, and then I scaled it to support up to 60 originators. Not just for 2 or 3, but for 60. Once I had the system and those processes all built out, it was like the movie Field of Dreams. If you build it, they will come. I scaled from 1 branch doing $40 million a year to 5 branches doing $40 million a month. And eventually to 7 branches doing $70 million in volume a month. And y'all, these were not COVID years. I did it without a recruiter. I did it without cold calls. I did it by being one of the most connected and one of the most visible people in my market, as well as our industry. I showed up at conferences, I showed up at events, I showed up online, and I showed up on social media. I built systems and processes that were best in class and made them scalable so talent would be attracted to us. When you are looking to grow your branch by adding originators or grow your region by adding branches, you have to start with the 3 types of people. Who are those 3 types of people who make a move, and how can you attract them? Those who need internal change but chase external change, those are the ones that we're very leery of. Those who are forced to move because their company is failing them, those are some of our favorites, but we have to already have a relationship with them. And those who are happy but open to something better, those are some of our best. Your focus should be on becoming the first call for the people in pain. We're building an operation so strong that the happy but ambitious ones eventually want in. You also have to understand you cannot be all things to all people. Your company might be a great company, but it is not the best company for everybody. So you must know who is your ideal originator. Your ideal LO or your ideal branch manager changes based on what you do well and what your systems and processes support. I've coached branch managers with very different answers. One branch manager I coached for years, she knew her ideal originator. It was someone about her age with similar experience who was seeking a collaborator and a colleague. Her ideal originator didn't need to be micromanaged. They didn't need to be trained from scratch. They simply wanted peer-level leadership and a strong example to follow. I have another young leader that I coach, and he knows his ideal LO so well. It reminds him of himself. 3 years ago. Hungry, high energy, uber competitive, not rich yet. We call them Henrys because they're high energy, not rich yet. They're newly licensed or early in their career. They're willing to grind, willing to work, willing to put in the hours to become the future of mortgage lending. They want to build something big and permanent. There's actually an exercise I'll put many of my producing branch manager clients through where we identify their ideal candidate. I recommend every hiring manager do this. The more dialed in you are, the more consistent you operate, the better your systems and processes are. The sharper you present yourself, the clearer you communicate, the stronger your sales culture, the easier it is to attract talent. Remember, you need to be the best leader for the right people, not the best leader for all people. So to put a bow on this and to wrap it up, understand that before you make your next career move or before you hire your next originator, you need the right information. You need someone unbiased. You need someone experienced. You need someone who has built branches, built regions, and run large sales operations. That's why my team and I have created and are launching TLOPS Career Advisory. It is a free service for mortgage brokers, loan officers, branch managers, even area managers. Whether you should stay, whether you should go, whether you should change yourself or change your environment, my team and I will help you figure that out. And if you are one of the 3 out of 7 where it does make sense to make a move, we would love to introduce you to some of the best leaders we know in this industry. And finally, if what you really need is a great business coach or sales training, please remember we offer multiple ways to partner with you through TLOPS Originator Coaching. We have options as low as $300 a month, all the way up to enterprise level coaching for entire sales organizations. Now, if you found this episode helpful, do me a favor, subscribe to our YouTube channel. If you're listening on Spotify or Apple, make sure you leave a 5-star review. If you haven't done so already, sign up for our newsletter by visiting our website, tloponline.com. That's TLOP online.com. I'm Dustin Owen. Thanks for tuning in to The DO Show.